Have you ever pondered over what your golden years might encompass? Have you ever allowed your imagination to wander, picturing how those tranquil later years of life could look for you? The image that comes to mind might be this: a vibrant period after your work years have concluded, characterized by a sense of tranquility, prosperity, and independence. It's a lifestyle cushioned by comfort, ease, and financial stability, something you've worked hard for and truly deserve. Now, let's be real. This picture might seem blurry at first, complicated, or even obscured by the myriad of life's responsibilities. Retirement may seem like a distant dream, an elusive future that's too far to comprehend, but that's not necessarily the truth. It's not an unattainable fantasy, it's a reality that is within your grasp. Retirement doesn't have to be a vague concept. Instead, it can be a well-defined concrete goal. Imagine a life where you don't have to set alarms for the early morning grind, where your time is truly your own. A life where you aren't bound by financial stress, where you can travel at ease, or perhaps enjoy a quiet afternoon in your garden. Picture your days filled with leisure, hobbies, family, and friends. A life where you are free from the hustle and bustle, free to enjoy your golden years as they were meant to be enjoyed. Now, the pertinent question emerges: how do you make this dream transform into reality? How do you navigate this path to ensure the golden years are exactly as you envision them? In India, the approach to investment planning and risk-return analysis is unique. This unique approach is deeply rooted in the socio-economic fabric of the country, which is a melting pot of different cultures and philosophies. With a population that is noted for its strong culture, the majority of Indian investors veer towards more secure investments. They are typically risk-averse, a trait that is as much a product of cultural conditioning as it is of financial prudence. Unlike their counterparts in more advanced economies, they do not have a big appetite for high-risk, high-return investments. Instead, they prefer to safeguard their capital, avoiding the lure of high returns that come with an equally high risk. This conservative approach extends to their choice of investment avenues as well. Indian investors have a distinct affinity for traditional investment instruments such as fixed deposits, public provident fund, and the national pension system. These are seen as secure and, more importantly, they offer guaranteed returns. However, this risk-averse nature also means that they often lack in-depth knowledge about the plethora of diverse investment options available in the market. This lack of awareness and understanding can limit their potential for higher returns. As a result, they often find themselves relying heavily on financial advisors or sticking to the investment products that they are most familiar with. But a lack of in-depth knowledge about diverse investment options often leaves them relying on advisors or sticking to familiar products. So how can you plan your investments for a worry-free retirement? It all begins with a simple yet crucial stage: clear goal setting. This is not merely about saying, "I would like to retire comfortably," but rather about describing in detail what your ideal lifestyle would look like post-retirement. Would you prefer a quiet, simple life in your current home, spending your days gardening, or do you envision a dynamic retirement, full of travels, adventures, and new experiences? Only you can answer these questions. Once you've painted a vivid picture of your dream retirement, the next step is to consider your regular expenses. It's important to be realistic and anticipate that some of the expenses you have today will continue into your retirement years. These might include costs for food, utilities, transportation, and maintenance of your home or car. You need to budget for these recurring costs meticulously. Furthermore, don't forget about your potential travel plans. Whether these journeys involve visiting family across the country or going on exotic trips abroad, you'll need to allocate funds for them. Consider factors like airfare, accommodation, food, and sightseeing expenses. Each of these will require a significant chunk of your retirement savings. Lastly, always think about your potential medical needs. As we age, the likelihood of requiring medical care increases. Thus, preparing a budget for potential health issues is a prudent move. Look at your family history, any existing conditions, and project what future medical expenses could be. Finally, estimate the required corpus based on your life expectancy and inflation. This calculation might seem daunting, but it will provide clarity for your financial planning and ensure a worry-free retirement. Once you have a clear goal, it becomes vital to take the next step. This step revolves around the concept of assessing your risk tolerance. Risk tolerance, put simply, is your personal ability to endure potential financial losses. It is a crucial factor that determines your investment strategies. This crucial assessment can be done through various methods. One of the most common ways is to use questionnaires. These questionnaires will ask you numerous questions related to your financial situation, future goals, and your response towards hypothetical situations. They may include questions about how you would react if the value of your investments plummeted, or what you would do if there was a sudden market downturn. Your answers help in determining your risk tolerance level. Another method to determine your risk tolerance is through consultations. Consultations can be done with professional financial experts or advisors. These individuals have a wealth of knowledge and experience to guide you in making accurate assessments. They will educate you about the different types of risks and how to manage them, providing a more personalized approach to understanding your risk tolerance. The assessment of your risk tolerance takes into account multiple factors. Your age, for instance, is a significant determinant. Younger investors can afford to take more risks as they have a longer investment horizon to recover from potential losses. Older investors, on the other hand, may prefer more stable and less risky investments as they are nearing or already in their retirement phase. Your existing assets and income sources are also considered when assessing risk tolerance. If you have a steady high income or substantial existing assets, you may be more willing to take on riskier investments. In stark contrast, those with lower income or fewer assets may be more risk-averse. All the factors mentioned above contribute to making an accurate assessment. This process might seem tedious and time-consuming, but it is a crucial step in making sound financial decisions and planning for a secure and prosperous future. After all, it's not just about making money, it's about making wise financial choices. Your risk assessment will guide your asset allocation. Diversify your portfolio across various asset classes to balance risk and return. In an Indian context, this could mean investing in debt instruments like FDs, PPF, NPS, and bonds to lower risk. Consider equity investments like mutual funds for long-term growth. Real estate can provide long-term investment benefits such as rental income and capital appreciation. Even gold, seen as a hedge against inflation, can be a small part of your portfolio. India offers specific investment options for seniors like the Senior Citizen Savings Scheme with high interest rates, annuity plans for regular income post-retirement, and even reverse mortgage to access cash using owned property. Though the latter can be complex and carry high risk, understanding risk-return analysis is crucial. Higher risk options like equity offer potential for higher returns but carry market volatility risk. Lower risk options like FDs and PPF offer lower returns but ensure capital protection. To manage risk, consider strategies like diversification, asset rebalancing, and systematic investment plans. Diversification spreads your investments across asset classes to mitigate risk. Asset rebalancing involves periodically adjusting your portfolio to maintain your desired risk profile. Systematic investment plans allow you to invest regularly in mutual funds to average out market fluctuations. In conclusion, planning for retirement is not a task to be taken lightly. Understanding your risk tolerance and exploring diverse investment options within the Indian context can help you build a secure future. Consulting a qualified financial advisor to create a personalized plan considering your specific needs and risk profile can be a valuable step towards a relaxed retirement. Remember, the journey to a comfortable retirement starts today. Your future self will thank you for it. So, are you ready to take the first step?